Hey, everybody, this is Todd Zempel, Gordon Asset Management, here today to share a webcast titled Charting the Course, Navigating Volatile Markets. Today is March 17th, 2023. Happy St. Patrick's Day. Hopefully you all have some corned beef and cabbage in the slow cooker and some Guinness on ice. So with that, let's jump into the disclosures. So again, our firm, Gordon Asset Management, is a registered investment advisor. Information presented today is for educational purposes only and is not intended to make an offer or solicitation for the sale or purchase of any security or investment. Investments involve risk and, unless otherwise stated, are not guaranteed. As you can read further in the disclosures, we will be sharing a lot of charts with you, charts and graphs, historical information that are derived from sources that we deem suitable and reliable, but all the data is subject to change. As always, anything we talk about, if you want to implement a strategy, make sure you consult with a financial advisor or qualified individual before making any of those decisions. So a quick few introductions. My name is Todd Zempel. I am partner and director of retirement plans services for the firm. With me, we have Glenn, the macro maven Moore. He is also partner in the firm and heads up the wealth management division. And then also dialing in briefly is the rebel with a cause, Joe Gordon, who's the managing director, managing partner of the firm. So the reason we are holding this webinar today, there's a lot of volatility in the markets. There's a lot of news about what's going on in the banking system. So we will address those issues. But the first few slides, we'd just like to set the stage about what's going on in the markets currently. So the chart on the screen is index performance going back to the good old days, 1/1/2020. So right pre-pandemic, back in the good old days before we're all working from home and paying a lot of money for groceries. As you can see, the performance cumulatively over that period of time, the NASDAQ is up 34%. So again, despite last year being kind of a crummy year in the markets, if you stayed invested over that time frame in the NASDAQ, you'd be up 34%, and the S&P 500 index up nearly 29%. The Russell 2000, so small caps, is up 10% in that period, so it's up less. Then the MSCI EAFE index, which is developed international markets, positive roughly 7%. And then if you held bonds in that time period, you would be down about 6%, as shown here under the Bloomberg US Aggregate Bond Index. And then if you own emerging markets, primarily China, you'd be down about 8% in that time period as well. Now, what I like to do is just take a little closer view of these indices. So looking at the same data year to date, you can see what has done well and what hasn't. Sort of the big surprise is the NASDAQ in that time period. The tech-heavy NASDAQ is up 12% year to date. The S&P is up 3.5%. The MSCI is up almost 3%. Bonds positive 2%. Russell 2, the risky Russell, not a lot of profitable companies in the Russell 2000 index. Based on the metric I saw, it's roughly about half are profitable, positive 0.88% year to date. And again, emerging markets actually in the negative year to date. So it is kind of interesting to see that tech has done really well year to date, and modest returns across the board elsewhere. Now, one of the other things we'd like to take a look at, so that's just index performance. That's how the markets have done. This is a view of commodities. So we just took a broad basket of different commodities, charted those over the same time periods, 1/1/2020, the good old days, through yesterday's market close. As you can see here, the big winner is corn, up 64%. And that really explains why we've seen food inflation. You know, it's not just corn prices that have gone up, but that corn goes to feed the hogs and cattle that go into the Big Buford burger that you eat. Copper up 40%. That's seen a strong rally on the back of EVs, electrification of the economy, and so on and so forth. Gold positive 30%, and even at the bottom, crude it's positive 12%. So we've seen massive increases in commodities across the board since really pre-pandemic and thereafter. And then again, if we zoom in just to year to date, how the different commodities have performed, gold is the big winner, up 7.64%. What's really interesting about gold is it's not necessarily an industrial commodity, but it is more so viewed as a hedge against geopolitical risk and inflation. And so it's kind of interesting that we see the biggest increases in gold year to date. Copper also relatively strong, positive 3%. Aluminum, everything else is negative. And so this is interesting to look at. Aluminum, cotton, copper, etc., corn, all negative, and with the biggest loser being oil year to date. So again, we've had this run in commodities, which obviously feeds into inflation, right? If our input costs go up, then the cost of the final product also goes up. But we're starting to see a little bit of a reversal year to date. So keep that in mind as we go through the rest of the presentation. Again, commodities have been on a rally, and that's really fed into inflation. So the chart on the left here shows headline and core CPI, Consumer Price Index. As of February, headline CPI was about 6%, core CPI was 5.5%. And you can see the 50-year averages are actually closer to 4%. But again, what's kind of interesting, if you look at this chart, you start to see a little hook down year to date. So although we've seen a lot of inflation, it looks like it's starting to back off. And then the chart on the right really breaks down the components of headline inflation where you can see the individual changes. The green bars here are energy. You can see that's been a huge deflationary factor in terms of the broader measure of inflation. New and used cars, everybody remembers paying a lot for a new car in the middle of the pandemic. Well, that's starting to reverse. One area where we hadn't seen things cool off is in shelter. Shelter continues to contribute to inflation, and it sort of makes sense, right? If we have higher interest rates, cost of housing goes up. So big picture, inflation's hot, but we're starting to see things cool down, likely on the back of what looks to be the beginning of a reversal in some of the commodities. Now, with inflation, right, the one way that the Fed really tries to keep things under control is through the use of interest rates, the Fed funds rate. So this chart shows the effective Fed funds rate going back to 2000. You all may remember going into 2008, pre-financial crisis, the Fed was raising interest rates. And then when the stuff hit the proverbial fan, they immediately cut interest rates effectively to near zero. Then in 2016, after having zero-bound interest rates for several years, they started to increase interest rates again. Then sort of reversed that and really reversed it again back to near zero during the pandemic. And then in 2022, you can see the trend here is the Fed has been hell-bent on getting inflation under control. So they've been consistently raising interest rates. And you can see right now the effective fund rates, Fed funds rate is around 4.63%. Now, what's really interesting about this chart is the blue line shows where the FOMC, the Federal Open Market Committee, who sets the Fed funds rate, expects interest rates to be in the future. You can see they're expecting interest rates to continue to climb before reversing likely in 2024. And then the green line shows where the market expects interest rates to be. The market's really expecting interest rates that we're near the peak, if not at the peak now, and the market is expecting a reversal. So they're expecting the Fed to eventually cut rates. So keep that in mind. Now, with interest rates, the low interest rate environment created very interesting set of circumstances for the broader economy. And what we refer to these circumstances as TINA. There is no alternative. So when interest rates were extremely low and the government was sending checks to everybody, cash flush investors were really disincentivized to park money in bonds at near zero interest rates. So what does that mean? People found other ways to make money, buying NFTs, throwing money in crypto, which apparently was a giant scam. So, when money's free, people do stupid things. Now that money's not free, there are reasonable alternatives. TERRA is the acronym there. So instead of throwing money in stupid crypto, which apparently was giant fraud, and NFTs, Bored Apes, and crypto kitties, more money is flowing into sort of traditional wealth building tools and methods, and primarily U.S. Treasuries. You can go buy Treasuries that are paying 4 or 5%. Bank accounts, high yield savings are now paying a reasonable amount of interest. And so having reasonable alternatives, it's taking a lot of the liquidity out of the markets, so out of stocks potentially, and just into these safe, kind of boring areas. And that's kind of been the story of the last year. Now, one of the things we will talk about in just a few minutes, and we'll get Glenn to chime in on this, is the crisis in banking right now. Everybody heard about Silicon Valley Bank. We will go into detail about what happened there. But to set the stage, I want to make sure everybody's on the same page and has a really base level understanding of bonds, the bond market, and how bonds work. So a bond is debt, right? So if I took $1,000, loaned it to Glenn, and Glenn repaid me with interest. That's essentially what a bond is. So if I loan $1,000 to Glenn, tell him to repay me in 1 year at 4% interest, that's essentially what a bond looks like. Now, if interest rates rise like they have in this last year, there's an opportunity cost to holding lower yielding bonds. So the Federal Reserve is now paying 4.65% in interest, and I loaned Glenn $1,000 at 4% interest. Well, that bond isn't worth as much anymore because I could just go to the Fed and loan them money at 4.63% interest. So if I were to sell that bond that I have with Glenn, I'm likely going to take a little bit of a haircut on the open market. And in the reverse, if interest rates fall, so if the Fed is now paying 3% instead of 4.5%, well, that money I loaned to Glenn at 4%, well, that demands a premium. If I could go out and sell that to somebody else, they may pay me more than $1,000 for that. So there is this inverse relationship between interest rates and bonds that's really essential to understand the banking crisis. Now, to take that a step further, investors typically demand higher interest for holding longer duration or higher risk bonds. So if that $1,000 I loaned to Glenn was for 10 years, not just 1 year, I'd say, well, I'm going to want more than 4% if you're going to lock up my money for 10 years. So maybe instead of 4%, let's do this at a 5% interest rate. Or if, in a higher risk situation, so if Glenn didn't repay me the last two times I loaned him money, I may say, well, instead of 4%, I'm going to charge you 10% on this bond, 10% interest. So higher risk, longer duration tends to demand a higher interest payment in return. And so how that plays out in the markets is that higher risk, longer duration bonds tend to be a lot more sensitive to moves in interest rates. And you can really see that on this chart over in the right. What this chart shows, it shows how a 1% rise or fall in interest rates affects various types of bonds. So when we look at the longest duration, 30-year U.S. Treasuries, a 1% fall in interest rates will generally increase the price of that bond by about 20%. So that's a sort of leveraged impact on the price. And then to the reverse, a 1% rise has a negative 13% on 30-year treasuries. And you can look at the rest of the chart. But again, essential to understanding what has happened in the Silicon Valley Bank failure, you need to understand both that there's this inverse relationship to interest rates and bonds, and that there's also this leverage movement that happens with longer duration or higher risk bonds. Now, again, I think it's really important to understand how the yield curve works and what the yield curve is. So the yield curve just plots the interest rate on varying degrees of maturity of U.S. Treasuries. So the bottom x-axis here is the duration. So on the left, it's very short duration, 3-month. On the right, it's very long duration, 30-year. And then on the x-axis, this is your interest that you would earn on that bond. In a normal environment, you have a upward sloping curve, like you see here in the gray, the gray line, which is actually what the yield curve looked like on December 31st, 2021. And that makes sense, right? If you have a shorter term bond, you're going to earn shorter term interest because there's not this duration risk of that money hanging out there for a very long time. Or if you have a longer term bond, a 30-year bond, you're going to want more interest because that money is going to be locked up for a very long time. So this upward sloping curve just makes sense, right? But times are funny. Right now, we have what's called an inverted yield curve, which is this blue line. So this blue line is how the yield curve measured on March 14th, 2023. And you can see it's nonsensical, right? Shorter term bonds are paying more in interest than longer term U.S. Treasuries. So why would that happen? Why would that occur? Why would somebody take 3.77% over 30 years when they can just cash in that money and buy a 3-month or 6-month Treasury at nearly 5%? Well, there's a lot of reasons for that. I would say that the biggest reason for that goes back to the earlier slide. It's all about expectations. So the market is expecting that the Fed will ultimately pivot and reduce interest rates in the future. So the market is betting that that will happen. And if it does, as we talked about, because there's this leverage type effect for longer duration funds, that the longer dated treasuries will really rally in that situation. So that's one reason why that may be the case. Also, big picture, when we have yield curve inversion, so when the shape goes from this upward slope to a downward slope, when that happens, that is a key indicator that recession is coming. If you took a look at the webinar we did back in November, it's also out there on YouTube. We covered a number of leading economic indicators, where we were with those and what they mean. One of the things we talked about was this yield curve. And when the yield curve inverts, that is a pretty good sign that recession is likely headed this way. Going back the last 50 years, every time there was an inversion in the 2 to 10 year spread, that has accurately predicted a recession. And you can see the months it took from the time that the yield curve inverted to when recession actually set in over all these different time periods. And the average is about 14 and a half months. And so the yield curve first inverted back in July of last year. So we've kind of been on recession watch based on historic norms. You know, who knows? Maybe this time is different, but I'm not betting on that. Then also, before I teed it up to Glenn, I want to mention that we did a piece that's published out to our blog back in January that Glenn authored. And really the theme of that market update was something's got to give. You know, we were looking at all these economic indicators, where interest rates were, where earnings growth was. And we ended up with the title, Something's Got to Give. And we think that, well, something gave. And that was primarily this banking crisis that we see working through the system right now. A lot of headlines out there. So with that, I'm going to pass it over to Glenn to provide an update on Silicon Valley Bank and the banking system there.
Thanks, Z. And hi, everyone. Again, Glenn Moore, and I'm primarily on the wealth side, and Joe and I co-chair our investment policy committee. So we come up with a lot of the thought leadership and also do a lot of the research, both economic and investment related, on what we're talking about and what's in our portfolios, et cetera. So go ahead and click to the next slide, Z. So what has gone on with Silicon Valley Bank and a lot of the other regional banks? It's pretty complex, and banks are fairly complex institutions just in general. So I'm going to try and boil this down to 3 points, but Joe may have a couple additional points that he wants to add as far as what has transpired really over the past 5 or 6 days, trading days, and kind of the speed with which all of this has transpired, whether it's Silicon Valley Bank or Signature Bank or First Republic. It's been pretty swift. And so there's been a lot of moving parts. But so as you can see on the bottom chart, there's really two kinds of securities that banks classify on their balance sheet. And you have what's called held to maturity, and you have available for sale. And so they're pretty intuitive in how they're named. Available for sale means that they can trade these securities and generate funds if need be. And so when banks are filing their financial statements, like their income statement and also their balance sheet, any gain or loss that is in the available for sale portfolio flows through to the income statement. So if there's gains, that is positive to their earnings. If there's losses, that's negative to their earnings. For held to maturity, the accounting classifications are such that the fluctuation in value is not necessarily reflected on the balance sheet and does not flow through to the income statement. And in most cases. And so when basically what happened, especially with Silicon Valley Bank, is that because we were in this depressed interest rate environment for the past, or really since the great financial crisis, where we've had, for the most part, interest rates have been artificially suppressed down at the zero bound. Banks haven't been they haven't been forced to offer interest rates on their deposits that are attractive or anything at all, really. And so they've been able to basically use the depositor money and pay no interest on it, which is great for them, because then they can go and at least lend it out to make loans where they're actually gaining some sort of spread on the interest. And so that's point number one. But now, since we've had this increase in interest rates, and it's been the most significant and rapid increase that we've ever seen, essentially from the zero bound to now we're at on that effective federal funds rate that's in the chart up top, we're at 4.6% almost. When that happens, as Z walked through in the bond math, when interest rates go up, bond prices go down. And so in the held to maturity portfolio, that loss of value is not reflected. And that's just an accounting rule. That's not, that Silicon Valley Bank wasn't doing anything wrong. And all of the other banks that have held to maturity securities aren't doing anything wrong. It's a function of what the accounting standards are. And so on paper, they were saying that these bonds were bought at 100 cents on the dollar and they were being valued at 100 cents on the dollar. But you and me and everybody else who owned bonds in their portfolio knew that last year that was not the case. And we had the worst year for bonds ever, where we had just the broad index was down, I think 13%, but at its worst, it was down 17%. And so, that's a 6 or 7 standard deviation move to the downside. And so where Silicon Valley Bank got in trouble, and this is leading to point number 2 on what happened there, is that because they have such a heavy concentration in technology-oriented companies that are mostly private and they're venture startup type companies, because now money is not free, a lot of these companies were no longer receiving these massive inflows of cash from investors. So these private equity and venture capital funds that provide liquidity and capital to these companies, that spigot got turned off once the Fed started raising rates. And so what was happening to an extent was that a lot of these companies were pulling deposits out of Silicon Valley Bank because their run rate was still at X, but the amount of money coming in was not meeting that anymore. So they were having to dip into savings and reserves that they held at Silicon Valley Bank. So as that money was being pulled out of the deposit base at Silicon Valley Bank, they didn't have enough money in their available for sale securities to match the deposits. And so then what Silicon Valley Bank was forced to do was they were forced to sell these held to maturity securities at probably the worst time possible. And so they had a massive hole in or they took a massive loss, which created a massive hole in their balance sheet and flowed through to the income statement. And essentially, Joe, if I'm correct, it wiped out all of the equity value basically of the firm, which was, I think, it was 1.6 or 1.8 billion. I don't know if you have that number off the top of your head.
They sold the bonds to Goldman for $20 billion and realized a $1.8 billion loss.
Yep. So, that's obviously a problem. And once that happened, what Silicon Valley Bank tried to do is they tried to, they issued a filing, and then they wanted to raise equity to basically try and plug that loss. And so once all of that was disclosed, essentially any savvy or astute investor that also was may have been either a venture capital investor that had money for his fund there, or was working with portfolio companies within his fund that of these companies that were venture capital backed. That's basically caused a run on the bank. And many of these people had millions and millions or hundreds of millions of dollars in the case of Roku. And it wasn't just private companies, actually, it was publicly traded companies as well. Roku had I think, close to 500 million in deposits at Silicon Valley Bank. And so everybody got really concerned when they thought that this bank was going to go under, and especially because they only had up to 250 or 500,000 of FDI insurance protection on their deposits. And so that's when really at the end of last week, you saw all of these warnings from people on social media saying, if you have any money at Silicon Valley Bank, pull it out immediately, because they just took a huge loss on their bond securities portfolio, and they're trying to raise cash to fix that. And so that's point number two. Point number three, it really comes down to the people that were running Silicon Valley Bank. I think of all of the people on the board, there was only one person that actually had any banking experience. The rest were either had technology backgrounds, or probably there was a little bit of cronyism going on where some of the other trustees knew people and they wanted to get them on the board of this very hip and trendy bank. And so what transpired was that the risk controls that were being implemented, well, actually, there were no risk controls, because for 8 months starting in 2022 or going into 2022, they didn't even have a chief risk officer. And so this would be the person that would be in charge of looking at the portfolio and saying, wow, we've got a lot of long dated securities, treasuries, essentially, that have extremely low yields. And we're looking at potentially a very significant and rapid interest rate regime environment. Maybe we should try and hedge this risk a little bit. No one was in that seat at Silicon Valley Bank. And so, that was huge red flag number one. But also just the fact that there just really wasn't anybody that really understood how banks operate and what should be, what should be done as far as a risk management standpoint. And so that's where Silicon Valley Bank was really caught off sides. Also, just, I guess point number 3A is that with a lot of these startup companies, they were also issuing loans to them, and so they were taking on debt risk. It wasn't just deposits; it was actual. They were making loans. 10% of their assets were in the form of loans to these companies that were profitless. We're not a lot of them weren't even generating any revenue. They were still kind of in their infancy stage. And so, essentially they were able to pay these high coupons, in many cases that would be double digits because of the risk involved. They were able to pay those coupons because of the inflow of equity that they were getting from investors. And so again, in this environment where money's not free anymore, that spigot was turned off. That was another reason why we saw really this unfolding at Silicon Valley Bank. And so, Joe, I don't know if you have any other points that you want to add, but those were kind of the biggest points of what happened and what transpired at Silicon Valley Bank.
The only other things, there's a ton of reasons why the bank failed. How would you feel if you were the CEO and in October 2021, the stock traded at $750 a share, and you rode it all the way down and sold your 3.6 million shares in the first quarter of 2023 for $2.3 million? I mean, you got to feel like you're the biggest fool in the universe. But when the risk officer left, somebody made a decision at the end of 2021 to take off all their hedges, interest rate hedges, their swaps. They had them on previously. So basically, they went into 2022, right when the Fed started raising rates, and essentially were running naked in interest rate exposure. They had duration mismatch, which is what Glenn already covered, where basically they were taking in short-term deposits and making longer duration investments. In a rising rate environment, you take a paper loss. And of course, they concealed those using a legal accounting rule and the hold to maturity securities. But like Glenn said, 10% of their loan book was into loans to startups. The way that worked was that essentially about 3 out of 4 companies they lent to were going to go out of business. They were going to vaporize. The 1 out of 4 that hit a home run, they had warrants attached to those loans. The warrants were money good and made exponential returns. They had an 18% historical net rate of return on those loans to venture companies, all financed by the warrant profits that were held. And I had a laugh this morning. The Heritage Institute published a paper on some other things that apparently were getting in the way of their focus. And it was remarkable to me that on the board, and I think that also sat on the risk committee last year, was the owner of a Napa Valley winery. Now, they know about risk, because if you have a bad harvest, you're not going to have a good production in the fall. But certainly, I don't know why you need a winemaker on your board, especially when most all of the loans this company makes are to tech and life science startups.
Yep. So again, this just drives home the point that I was making earlier is that in normal cases, your bond portfolio, you may see intra-year small declines, but for the most part, especially over the past 12 years or 13 years post Great Financial Crisis, bonds actually have done pretty well. You see a lot of years where it's mid to high single digits, especially in 2018 and 2019. And then you have that one big down year in 2022 of down 13, but intra-year down 17. And this is just on the broad aggregate bond index, which I think has a duration of about 7. And so again, if you were owning bonds that had a duration of longer than 7 or a maturity of longer than 7, you did even worse. And so this was where Silicon Valley Bank was really caught off sides, especially in their held to maturity portfolio, because they had to sell really at the worst time in history ever. And that was really part of what we were talking about with something's got to give, is that in this whole environment where the Fed has been raising rates and raising rates at a very significant and rapid pace, something was going to happen. What that was, that's the unknown. But as the Fed was tightening the screws, we were getting the feeling, and the data was supporting it, that they were really starting to over tighten the screws. And anybody who's ever done that, likely you're going to break either the screw or whatever you're trying to screw in if you really over tighten it. And that's kind of the analogy of what the Fed has done. And so now we sit here with next week with the March Fed meeting, and the big question is whether they're going to raise or not, and if they do, how much do they raise?
So also worth adding to this is we've had lots of calls this week from concerned clients, businesses and individuals wondering why all the regional bank stocks are cratering down, 15 to 30%. Some of the major headline ones like First Republic down 70% at one point. And many of them were having some of a run on the bank. But one point worth noting is Silicon Valley Bank is an aberration. They only had 3% of their deposits that were in what are called sticky deposits, meaning they were underneath the $250,000 FDIC threshold. On average, most all of the regional and community and even larger banks have between 30 and 40% of their deposits and sticky deposits, meaning people park the money there. They know they have the insurance. It's under 250,000, and they don't worry. They can sleep at night about knowing that their money will be there when they want it. And so that has caused a lot of people to speculate, should we be moving our money? We've had businesses call. We've been told we should better go open an account from our community bank at a money center bank. And even one of the most conservatively run banks in North Carolina, we had a question about that. And I said, well, the money center banks are more aggressive than they are. Why would you move it to them? So it's really been interesting to watch the behavior. Now, I think the canary in the coal mine will turn out to be Silicon Valley Bank. They basically called the Fed to wake up and realize there's a lot of cracks in the dam, so to speak, in the financial solvency of our banks. If they had to mark to market, hey, we're investment advisors. Our clients we have to mark to market. We have to show that 13% loss in intermediate bonds last year, the worst in history or the worst in 50 or 60 years in bonds dating back to the 70s. And so when you think about that, and then, how come banks get a free pass? It's all about regulations and this whole mark to market and hold to maturity game. The regulators were asleep too. Think about it for a minute. The CEO of Silicon Valley Bank was on the board of governors of the San Francisco Fed. I'm calling that was a fox guarding the regulatory henhouse. There was zero oversight. So a lot of these people didn't have any clue what was going on at these banks. And of course, you never do until it's too late. And so with all that said, I don't think on average, a lot of the regional banks in our backyard in the Southeast, they're fine. But they're people that when you worry behaviorally, you're going to go do something and you shoot and ask questions later. You're not going to wait around and calmly think about it and go to sleep tonight and think that everything will be okay. And I know a lot of people have fresh memories of 2008. They're thinking this is the same thing over and over. The only similarity between this and 2008 is, once again, capitalism's great in a bull market, but we socialize the losses in a bear market or a collapse. That's what's really got a lot of people upset when the federal government decided we're going to backstop all the uninsured deposits, because that means all the richest people win when it's good times, and they also don't lose when it's bad times, when they had the most exposed. And that's what Silicon Valley Bank had. Most all the assets in the bank were seeded from startup companies, Series A, B, and C funding by tech venture capital billionaires. That's where, and they also were the ones on Twitter and other social media that sounded the alarm, which led to the run on the bank in the first place. So I've heard lots of podcasts on this in the last 7 days, a lot of good information about what was really going on. This is a one-off, in my opinion. Signature Bank has its own other issues. I thought it was funny. Barney Frank of Dodd-Frank fame was on the board of that bank. And so seriously, all this Dodd-Frank regulation, it's great to have rules, but if there's no one enforcing them, then you're going to have this happen eventually. And here we are.
And then also big picture, again, we did a lengthy webcast back in November. Again, you can go on YouTube and view it, where we went through all the leading economic indicators: yield curve, unemployment, consumer confidence, housing starts, et cetera, et cetera. I'm not going to go through those today, but I highly encourage you to go back and check out that webcast and learn more about the leading economic indicators. So to wrap things up, where are we headed from here, Glenn?
Well, clearly there's one of three options that's going to happen on next week, and either the Fed is going to raise rates, they'll not do anything and leave rates unchanged, or now there's speculation that because of the stress and the damage that's been done in the small bank sector, is that there is whispers now, or some of the financial media pundits are saying that the Fed should actually cut rates. And so, if there's a pause where they do nothing, or they actually start to cut rates, who knows what's going to happen. I mean, if you were to force us to make a estimate or wager on what would happen, I would probably say that there would be an initial rally, and people would kind of go back to the mantra of, oh, if rates go down, that means buy stocks, because the Fed is going to backstop everything. To me, I think that if the Fed does pause, or if they pivot, that would likely long-term be a worse situation, simply because I'm not thoroughly convinced that they're going to get inflation down to back to 2%. I think that rates or inflation is going to be higher. It's going to level out at higher rates than that 2% historical number that it has. And so if the Fed actually goes back to cutting rates, I think that could cause a whole nother myriad of problems down the road. And really, I don't know what a good outcome is, because if the Fed hikes when the market is thinking, and a lot of the Fed futures now are basically saying that it could be a 0.25% increase, or I think more so, they're estimating that there's not going to be any change to the Fed overnight rate. If they do raise 0.25%, I think that markets would see that as the Fed being too aggressive. But when you look at the dual mandate, which is price stability and employment is still tight, and the inflation is still at it's coming down, but it is still at historical highs. And so if you just look at those two things, and quite frankly, if you just listen to what the Fed officials have been saying, they haven't indicated that they're going to be doing anything different than what they have been. And they've signaled that likely a 0.25% increase is what they'll do. And so, yes, you do have economists at Goldman Sachs saying that you shouldn't do anything, but there's a lot of other people. I was on Lacey Hunt, who was the chief economist for the Dallas Fed. He says that likely it will be a 0.25% increase. And that was just on a webinar yesterday. And so, the fact that there is this much diversity of opinion, to me, says no one knows what's going to happen. And so I'm not handicapping this at all. I have no lean that I would say if the Fed is going to raise rates or do nothing or cut rates. These are just the three scenarios that could happen, and what would likely happen in the immediate term and the intermediate term, based on these three different scenarios.
I was going to add, if the environment we are walking into, with the canary in the coal mine being Silicon Valley Bank, is anything reminiscent of the financial crisis of 2008, I want to remind folks that what really rebounded in late 2008 that carried the highest returns were long-dated treasuries and also gold. Gold on this news in the last week has moved up earlier today, trading at $1,962 an ounce. And long-dated treasuries have been really moving in the last week, because this has only been a week. since the noise of Silicon Valley Bank began on Wednesday a week ago. And long-dated treasuries are up 10% almost year to date. So I think the fact that the market's selling off today in a very big way, led by financials going down, a lot of people are voting with their money, with their feet. I think there's a lot of people wanting safety and no risk assets, and they don't have any confidence in the Fed. Let's face it, the Fed didn't see this coming. You would have thought they would, with all the regulatory oversight and with all of the complex rules. I guess maybe what they're shocked about most is that there actually were banks out there that did not use interest rate hedging techniques or swaps primarily. You make less money when you buy swaps, but you also don't lose money when you have rising rates like this. So with that said, I think they're going to raise 25, in my opinion. And the reason is egos. Egos are large, and they live in a bubble at the Fed, and they're going to have to do it to show it. But if they really had any good leadership, which I would question at this point, they would take the information they're seeing and realize, Houston, we may have a problem here. Let's just sit on our thumbs and say we're pausing right now until we digest all this information. But who knows?
Thanks, Joe. Thanks, Glenn. So big picture, if you do have questions, you could submit those via the Q&A function on the Zoom panel. We'll address those. The first couple questions that came in, let's see, I'll throw this out to Joe. So Joe, what this person is saying is if Goldman essentially pushed for a public offering versus a private one, do you think that is what essentially spurred the quote unquote run on the bank? If it was handled privately behind the scenes, do you think that there essentially wouldn't have been a run on the bank and that this would not be an issue? Thoughts?
That's a great question. And the funny joke on Wall Street this week is that you never announce you're going to do an equity offering on the spring of taking out $20 billion for a client and them realizing a $1.8 billion loss unless you've already raised the equity. You don't announce you're going to raise the equity unless you've already raised the equity. And they, in the comments in a couple financial podcasts, were the fact that they announced it the way they did, it didn't, and it's almost like they knew no one would invest in it. It was kind of like an afterthought. So Goldman will have to answer to that, but the protocol Wall Street is you never announce an equity raise unless you've already raised the equity, and most times privately.
Great. So we'll hang out for another few minutes to see if any additional questions come in. But as we wrap things up, I do want to throw out a value add for anybody that's on the webinar. We do have access through MassMutual to this tool called Flourish Cash. This is something that's been getting a lot of press lately as we've had these bank runs. Essentially, what this product does is it links to your bank checking account or savings account, and it farms your money out to several member banks. So you can spread around the FDIC protection. So if you're somebody that has more than $250,000 in a checking account, you're concerned about what's going on with your bank, this is a really great option. We're not the only ones that have access to this. Your bank may have other member banks that they can do the same thing with. What we like about this tool is it is super easy. There's no minimums. There's no express fees. Flourish just makes their money on the interest rate spread. We don't get paid on it. It's just a service that we make available to clients and friends of the firm. But again, because they have several member banks, you're able to farm that FDIC coverage out. So they offer $1.5 million in FDIC coverage for individual accounts, $3 million for joint accounts, and $1.5 million for business accounts. And the interest rates are pretty good. So for individual accounts on the first $250,000, they'll pay 4.25%. Again, no minimum, which is really nice. Joint accounts, they'll pay 4.25 on the first 500,000 business accounts, same 4.25 on the first 250, and then 3% on assets over those amounts. And then the big news today, we just got the email, effective on the 17th of next month. They're actually going to increase those tiers. So for individual accounts, you'll be able to earn 4.25 in the first 500,000, or joint accounts on the first million. And so that'll go into effect April 17th. If you are interested in that, shoot us an email at info@wealthqb.com. Just include your contact information and include the word Flourish in the subject line. And we will get an invitation out to you. Again, it's just a service we offer, we introduce clients to. It's not our product. It's just something that we make available to clients.
It's important to know, just to follow up the folks managing expectations here, is those rates are not set in stone. They're fluid. They're following short-term treasuries. A year ago in 2022, we were earning about 0.50. And then as the Fed started raising rates, and by the way, nobody cared a year ago in the first quarter in 2022 because you weren't earning anything. And so as the Fed raised rates throughout 2022, these rates started spiking. So they're at 4.25 now. But let me remind folks that with all the excitement that's going on in the banking sector, the 2-year Treasury peaked at 5.08 last week, and it's below 4% today. So these rates are not going to stay at these levels. Just know they're going to be fluid based on short-term treasuries in general. So you'll be getting this rate for now, but if the Fed cuts in the next 6 months, these rates will come down. But at least you're getting the highest interest you can get for short-term savings, and you've got the FDIC protection.
Yeah. And again, it's daily liquid. So you ACH money in and out within 24 hours. So it's not like a CD where your money's locked up for a period of time, which I love. So very cool tool. It's out there. If you're interested, shoot us an email and we can get you set up. So it looks like that really covered all the questions for today. If you do need assistance, want to reach out, visit our website, wealthqb.com. You can schedule a meeting with us directly there, or shoot us an email, info@wealthqb.com. Follow us on social media. Again, schedule a meeting with us. If you are interested in this kind of content, we also have a podcast. We are going to be recording a new episode on Tuesday with one of our favorite recurring guests, James Abate with Center American Select. So that should be up by the end of next week. Also, YouTube's a great resource, as well as the blog on our website. So folks, we'll leave it at that for today. Thank you so much for your time. Thank you very much for your confidence in our firm. And I hope you all have a very happy St. Patrick's Day. Thank you.